Let's get one thing straight. The rich don't play by the same financial rules as everyone else. They've learned to navigate the tax system in ways that most people wouldn't even think about. And no, this isn't about outright evasion. This is about using legal loopholes, strategies, and systems to minimize tax liability. Today, we're going to break down 10 ways rich people avoid paying taxes, not to glorify it, but to understand it. Because knowledge is power, and if you understand the game, you can start playing it too. Number 1. Leveraging tax havens. Rich individuals and corporations often park their money in countries with low or no income taxes. Places like Switzerland, the Cayman Islands, or Singapore are popular tax havens. By setting up offshore accounts or shell countries, this strategy is to raise questions about fairness. The rich know how to structure their finances globally, while most people only think locally. Number 2. Capital gains over income. Instead of earning a salary, many wealthy people rely on investments. Why? Because the money earned from selling investments like stocks, real estate, or businesses, called capital gains, is taxed at a much lower rate than regular income. In many countries, capital gains taxes are significantly lower than income taxes, which is why the rich focus on building assets instead of relying on a paycheck. Number 3. The real estate advantage. Real estate is one of the richest playgrounds for tax benefits. Through depreciation, property owners can claim a reduction in their taxable income, even if their properties are appreciating in value. For example, if you own a rental property, you can deduct the cost of wear and tear, even if the property itself is increasing in market value. It's a win-win for the wealthy. Number 4. Tax-deferred retirement accounts. Wealthy people maximize contributions to tax-deferred retirement accounts like 401k, IRAs, or similar plans in their respective countries. These accounts allow them to delay paying taxes on the money they invest until they withdraw it, often at a lower tax rate during retirement. By doing this, they let their investments grow tax-free for decades. Number 5. Charitable donations. Philanthropy isn't just about generosity. It's also a strategic tax move. When the rich donate to charities, they receive significant tax deductions. Some even set up their own charitable foundations, giving them more control over how the money is spent while reaping the tax benefits. Think of it as a way to keep wealth within their sphere, while reducing their taxable income. Number 6. Passing wealth through trusts. Instead of directly passing wealth to heirs, the rich use trusts. Trusts allow them to transfer assets while avoiding hefty estate taxes. For instance, a grantor retained annuity trust, GRAT, lets them pass on wealth while keeping future appreciation out of the taxable estate. It's a legal loophole that ensures their money stays within the family. Number 7. Borrowing against assets. Here's a clever one. Instead of selling stocks or assets to access cash, which would trigger capital gains taxes, the wealthy borrow money against their assets. For example, they might take out a loan against their stock portfolio or real estate holdings. The interest on the loan is often tax deductible, and the loan itself isn't taxed. Number 8. Business expenses as deductions. Rich people who own businesses often use company expenses to reduce personal tax liability. That luxury car? It's a business expense. The lavish trip? A business meeting. Even meals and entertainment can be written off under certain conditions. By running personal expenses through their businesses, they lower their taxable income. Number 9. Profit shifting. Large corporations and wealthy individuals use profit shifting to minimize taxes. They transfer profits from high-tax countries to subsidiaries in low-tax jurisdictions. For example, a tech company might move its intellectual property rights to a country with low taxes, and then charge its U.S. operations for using it, reducing profits and taxes domestically. Number 10. Life insurance policies. The rich use life insurance as a tax-advantaged way to grow and transfer wealth. Permanent life insurance policies, like whole or universal life insurance, allow them to accumulate cash value that grows tax-free. When they pass away, the death benefit is transferred to heirs tax-free, avoiding estate taxes. It's a long-term strategy that protects their wealth. What you've just heard are strategies, some simple, some complex, that allow the wealthy to legally avoid paying a significant portion of their taxes. While these methods are perfectly legal, they're often out of reach for the average person, not because they're secret, but because they require access to capital, specialized advisors, and a deep understanding of the tax code. The lesson here isn't to be frustrated, it's to get informed. Start learning about the tax system, even at a basic level. Focus on building assets and structuring your finances in ways that work for you. Because if the rich are doing it, why shouldn't you? Knowledge is the first step to leveling the playing field. And remember, the tax system is complex by design. It rewards those who take the time to understand it.